Syria, Iran, North Korea, Putin, Trump. It feels like a volatile time. And in volatile times, where do we turn? To drink, perhaps. But I was thinking more of a metal. Yes, indeed, it's our friend gold. To find out more about the outlook for gold, our next guest brings over 20 years in commodities research and trading experience, provides advice on commodities and FX. He is the Senior Commodity Strategist for ANZ. Please join me in welcoming Daniel Hynes. Daniel.
All right, thanks, Andrew. It certainly has been a pretty interesting 12 months, as Jordan alluded to, and certainly the amount of inquiries I got about Bitcoin and cryptocurrencies certainly escalated quite quickly towards the end of the year. But you know, the discussions have certainly come back to you know, what is the outlook for gold in itself now that things have calmed down on that side of things. And from our perspective, you know, we're pretty confident about you know, where things head. I mean, obviously, gold is impacted by a whole plethora of issues, and these are some of the things, you know, we've been looking at the moment. Obviously, the global markets and the subsequent volatility we're starting to pick up is quite important, but there are obviously a lot of other issues which are really pertaining to you know, the outlook for gold at the moment, and I'll run through all of these issues through this relatively quick presentation. Now, obviously, you know, gold has always been linked to the US dollar, even despite you know, the gold standard you know, being removed in '71, and as you can see over the last few years, that relationship has been pretty strong. You know, for us, you know, the outlook for the US dollar is a little bit more nuanced now that I suppose we're entering you know, quite a unique period after, I suppose, years and years of stimulus measures and easy money essentially being pumped into the markets. You know, we are now at a point where we're starting to see interest rates rise. But more importantly, in the US, you know, we are looking at now a situation where we have you know, the issue around twin deficits around the budget and current account balances in the US, which are certainly going to weigh on the dollar. But also broadly, you know, on the global economic front, we are starting to, or have seen actually for a little while now, the synchronised global growth. Now, there are signs that, you know, that may be starting to ease just a tad, but certainly, you know, the US was really the first to come out of that financial crisis and start to produce some relatively solid growth. We're now starting to see other major economies, such as Europe, Japan, you know, catch up to the US, and that is, as a result, lessening, you know, the impact on the US dollar. Certainly, though, at the moment, you know, we're starting to see US bond yields rise quite significantly. You know, the 10-year just pushed above 3%, and certainly in the shorter term, that is going to be an issue. And also, you know, the investor positioning on the US dollar had been relatively short, and we are starting to see that that position unwind to a sense due to the rise in yields. And I think for the moment we're going to have to you know, wait out, I suppose, as we do see some short-term strength, in the US dollar, which could weigh on the gold price in the shorter term. But we are starting to see a whole host of other issues, you know, in the financial markets support gold. Rather than inflation itself, expectations of inflation tend to be an important driver of the gold price. This chart here you can see over the past 6 years shows a pretty strong correlation between the gold price and the 5-year break-even, which is essentially an indication of future expectations of inflation by the market. In the US, we've seen a huge fiscal stimulus brought in by President Trump on the back of those tax cuts, which should result in some levels of inflation starting to emerge, certainly when you put it against a backdrop of a relatively full level of employment in the US. We have seen inflation picking up broadly across the world. Inflation picked up actually to about 4.2% in 2017, and we expect to see that rise even more in 2018. Just recently, we saw the retail sales in the US pick up 0.3% in April, and CPI core inflation picked up around 2.1% in April as well. So that, in combination with the rising energy and oil prices, which is certainly starting to have an impact both on the consumer itself, as well as broadly speaking, the rise in yields, we are expecting to see that those expectations of inflation start to pick up. So we do think that'll be a supportive factor for gold over the medium term. But certainly financial conditions are starting to tighten. This is an index showing the financial conditions in the US and Europe against our ANZ CCI precious sector index, which is essentially tracking the gold price. And you can see in the shaded areas where we have seen tightening conditions as a result of central banks reducing their balance sheets. We have had periods where gold has actually performed relatively well, particularly prior to the financial crisis. We saw tight financial conditions, but also rising gold prices. That did reverse slightly in 2013 to 2015, but once again, now that we're starting to see financial conditions rise again, we are still seeing that gold price start to increase. But the rise in interest rates isn't always a death knell for gold. What we've done in this chart here is actually show the performance of gold from the first rate hike through to the end of that interest rate cycle. And as you can see, over the past 6 rate hike cycles in the US, gold has actually performed or outperformed over that period. The only time it has underperformed or fallen, in essence, over that period was back in 83, 84, which we had significant other issues impacting the gold price. So, the rise in interest rates, particularly by the Fed, is not a major issue. And part of the reason why this happens, I think, is due to expectations leading into each interest rate hike. So you can see here the red star indicates when rates were hiked by the Fed over the past few years. And every time leading into that rate hike, we saw gold prices weaken off the back of the expectation that we would see interest rates rise over the near term. Post that decision, they tended to rally. So we think, leading into this current rate hike cycle, which has been going on for a little while now, the first one was back in December 2015, we're going to see a very elongated sort of cycle this time around, but certainly leading into these rate hikes, and we expect the Fed to raise rates at the June meeting coming up, and then twice more in 2018. We're going to see these periods where gold prices do weaken, and certainly at the moment we've seen gold just push back below that key $1,300 an ounce psychological barrier just recently. But post the next rate hike cycle, we do suspect we'll see the same sort of recovery. On the physical side, while not a day-to-day driver, as Jordan did allude to, it is important over the medium term. And there are signs that things are starting to pick up. China, battling with India as the biggest gold consumer, has had sort of an up and down period over the past couple of years, but certainly through 2017, we saw a strong recovery in gold consumer demand. where that has been a little bit volatile in the months and quarters just recently. But we are particularly seeing strength in the jewellery sector after, I suppose, a period where it was certainly impacted by the anti-corruption probes that the President Xi had implemented at the start of his presidency. But now that that is starting to abate somewhat, the jewellery demand sector is starting to pick up. At the moment, though, it is being held back. Overall demand is being held back by that weak investment demand in that sector. On the Indian side, we've had a whole host of issues really impact demand, and certainly through 2015 or 2016 in particular, we saw the implementation of the GST. We saw the removal of small banknotes in the country, which was a real driver of urban demand of jewellery for gold, and certainly tariffs placed on jewellers, and even constraints on the import of gold into that market as well. They all really created quite a soft patch in Indian demand. In fact, you can see the levels that we saw fall over the course of 2016 and even into 2017. But we did see in the second half of last year signs of recovery. That festival season last year was relatively strong compared to the last couple. There were signs that jewellers on the ground were starting to see increased activity. But as you can see from the Q1 number there, which fell from 2017, the situation is still fragile. But overall, globally, I think the recovery, the globalised, synchronised recovery in the economy is starting to play out in terms of demand, jewellery demand. You can see here, the huge increase in French exports of jewellery, which is a key source of obviously global jewellery production, and also Tiffany sales, which had been quite weak through the past few years. We saw a fairly strong rebound in 2017-2018. And then on the supply side, an ongoing issue which I'm sure you guys will discuss over the next couple of days is mine supply. It hasn't been easy going despite the relatively good conditions. Certainly here in Australia, the Aussie dollar price has been actually quite strong over the past few years, but it is becoming increasingly difficult to mine supply, and we're seeing weakness in the output of supply as well, supporting gold. But for us, it's around the volatility issues, and certainly this comes back to, I suppose, the rising geopolitical risks that we're seeing in the market right now. And I don't have to sort of spell out all those issues which we do see bubbling away in the background. But for us, market liquidity is going to have a big impact when these types of events occur. Now, we've developed this market liquidity index, which not only looks at official liquidity by the central banks, but also market liquidity in particular. And you can see through 2012, 2013, right up to 2015, we saw a huge level of liquidity hit the market, which I'm sure you're aware. That obviously decreased slightly through 16, but then rallied again through 2017. We're now starting to see that start to fall. Obviously, the shrinking balance sheets of central banks are having a part to do, but certainly market liquidity is drying up quite quickly. Why that's important is because it has a pretty strong relationship with volatility. And you can see here we've charted that liquidity index against the VIX, and you can see particularly earlier this year in February, where we saw that real spike in VIX after the collapse of equity markets in February, was preceded by a fall in that liquidity index. And volatility, as a consequence, has a big impact on the gold price. You can see here, this is the performance of gold post some of the major events that we're seeing over the past 20 years. Back in the long-term capital management sort of era, and certainly 9/11, we saw a relatively strong and sustained reaction in gold prices as a result of those events. But certainly post that, interestingly, through the Greek debt crisis and the Chinese stock market crash, and even Brexit, the impact of those events was relatively limited. In fact, in some cases, we actually saw gold fall subsequently over the next 30 or 60 days. But with that volatility starting to increase on a sustained basis, we do suspect that the impact on the gold prices will be quite significant. This just shows you, I suppose, that the geopolitical risk relationship with the gold price, and we have had a relatively good correlation, particularly with the US political risk and uncertainty really driving gold prices. And you can see just recently that has taken a back seat somewhat to the gold price. But we do expect, with that increased level of volatility starting to emerge now, we'll start to see that type of spread increase. But interestingly, that combination now with volatility should have a relatively positive impact on gold. So if you think back to that liquidity chart that I showed before, we have the liquidity index falling and essentially going into a negative situation. And that is what we call the third phase. And as you can see by here, when we do have that situation, we have a fall in the Aussie dollar, as you can see in that blue bar, but we have quite a significant pickup in the gold price, which is shown by the orange bar there. So essentially, when we get these types of volatile events occurring in the market, gold's store of wealth mentality is certainly going to come to the fore, and we do expect to see gold perform relatively well. When we have a relatively positive outlook on the price itself, we expect to see gold at around $1,400 an ounce by the end of the year, and that's based on that US dollar starting to weaken somewhat, physical demand picking up, and also that level of volatility really starting to rise, which comes at a time when the geopolitical risks are certainly rising. Thank you very much.